All right, let's just jump right in. We talk a lot about how AI is changing technology, right? But today we're going way bigger. We're talking about something that underpins, well, everything, the tax code. Because there is a massive economic rebalancing happening under our noses, and it all starts with AI's impact not on silicon chips, but on your wallet. And more importantly, on who the government is going to tax next.
Now, I know this sounds like some crazy headline, but listen, when the CEO of OpenAI, Sam Altman, starts talking about a tax system that's skewed away from labor and toward capital, you listen. And when a financial titan like Jamie Dimon says pretty much the same thing about where profits and wealth are going, you pay very close attention. See, this isn't a tech story anymore. This is a tectonic shift in the global economy. It's a signal that the very foundation of how our governments get funded, the income tax on human work, is starting to crack.
And that really brings us to the core question of this whole explainer. When human labor isn't the main engine of economic value anymore, the rules for how you build wealth just completely change. The new game is all about owning the capital, owning the infrastructure, owning the bots. So the real question is, for you, how do you make sure your portfolio is on the winning side of this great tax rebalancing? That's what we're here to figure out. So here's how we're going to break this down. First, we'll look at the history to see how we got here. Then we'll dig into the big problem, a shrinking tax base. After that, we'll look at how governments are pretty much forced to respond. And then we'll get to the good stuff, the investor playbook, how to own the right things and use the right strategies. And finally, we'll wrap it all up with what this new financial reality means for you. All right, first up, to really get the scale of what's happening today, we got to zoom way out, because this is not the first time the very definition of wealth has been turned on its head. You know, what's so cool about this is how it maps out economic power. For centuries, if you owned the land, you had the wealth. Simple as that. Then, boom, the Industrial Revolution hits, and all that power shifts to the people who owned the factories, the means of production. Today, we say information is wealth. But here's the twist AI brings. It's not just about having information anymore. It's about owning the capital and the actual infrastructure that processes all that information. That is the next great rebalancing, and it's happening as we speak. Okay, so if the source of wealth is shifting, that creates a huge problem for a system that's built on the old model. This brings us to the central challenge, the slow, steady erosion of the labor-based tax system. The legendary investors Buffett and Munger had this thing called second-level thinking. It's not about seeing the obvious. It's about always asking, and then what? So first-level thinking is, AI will make businesses more efficient. Okay, great. But second-level thinking asks, and then what? Well, if AI replaces human tasks, companies need fewer workers. And then what? The government collects way less income tax. And then what? The entire funding model for roads, schools, hospitals, all of it starts to fall apart.
And look, this isn't some abstract idea in the distant future. The data is already pointing to this massive transition. Just in the UK, they're projecting AI could displace around 4.4 million jobs. Now sure, new jobs will pop up, of course. But here's the crucial question. Will those new jobs generate enough tax revenue to fill the giant hole left by the old ones? The early signs are not looking good.
And this slide just lays it out perfectly. For the last century, the economic engine was pretty simple. More jobs meant more income, which meant more tax revenue. Easy. But in this new reality, you can have absolutely massive economic growth and wealth creation thanks to AI, while the human labor market and the tax base it supports actually gets smaller. That is the crack in the foundation, and governments have really only one way to fix it. So if you can't tax people's paychecks as much anymore, where do you go? You follow the money. And the money is flowing not to labor, but to capital. This is the pivot. This is what's going to define fiscal policy for the next decade.
So let's be super clear about what we mean by this. Capital-based taxation is just a system where governments start to rely more on taxing profits from investments, your capital gains, than on taxing the salary you earn from your job. And this isn't about politics, left or right. It's just fiscal necessity. When assets are what's generating all the wealth, governments have no choice but to tax the assets. And hey, if you think this is all just theory, just look at what's already happening. Canada recently made a pretty big change to its tax code. They jacked up the capital gains inclusion rate, that's the portion of your profit that gets taxed, from half to 2/3 for corporations and high-income folks. This is a real-world, tangible example of a major country starting to shift that tax burden right onto capital. This is a blueprint, and you can bet it's just the first of many moves like this we're going to see around the world. Okay, so we get the problem, and we see the government's inevitable reaction. Now for the fun part. How do you actually position yourself to win in this new world?
Let's get into the investor playbook. The first strategy is simple. It's as old as the gold rush. Don't bet on which miner will find gold. Sell all of them, the picks and shovels. The amount of money being thrown at this build-out is just staggering. The biggest names in tech, Amazon, Google, Microsoft, you name it, are pouring over $700 billion a year combined into building AI infrastructure. They are in an absolute frenzy to build the physical foundation of this new economy. This tells you everything you need to know about where the real value is.
So what are they actually building with all that cash? Well, it's basically this three-tier system. First, you've got the giant cloud data centers. That's for the really heavy lifting, training these huge AI models. Then you've got servers on site, on premises, for what they call inference. That's just the AI doing its job, like answering your question. And finally, you have edge devices, like your phone or your car, for things that need to happen instantly, with zero lag. And each of these tiers needs its own special kind of hardware. In this right here, this is the heart of the asset-heavy playbook. We're talking real physical stuff, high-performance chips like GPUs and custom-made ASICs, insanely advanced cooling systems to stop everything from melting, miles and miles of fiber optic cables, and under all of it, a crazy demand for energy. That's why you see companies like Microsoft looking into building their own nuclear power plants. These are the literal building blocks of the AI revolution.
And of course, the perfect case study here is NVIDIA, right? The company's insane rise isn't just about a hot product. It's a direct reflection of this crazy, insatiable demand for the physical hardware, the picks and shovels that every single company playing in AI absolutely has to have. This is what owning the infrastructure looks like. Okay, so owning the physical stuff is strategy number one. But just as important is understanding the financial infrastructure that's going to win in this new tax world. And that brings us to our second playbook strategy. It's all about how smart companies give value back to you, the shareholder, in the most tax-friendly way possible. Okay, so companies basically have two ways to return cash to shareholders: dividends and buybacks. Dividends are simple, but they get taxed twice. The company pays tax on its profit, and then you pay income tax on the dividend you get. But a share buyback? That's different. The company uses its cash to buy its own stock off the market, which makes your slice of the company bigger. The result? Your wealth goes up, but since no cash hit your bank account, you don't have an immediate tax bill. In a world of rising capital gains taxes, that tax deferral isn't just nice to have, it's a superpower. The way it works is actually beautiful in its simplicity. So say a company has 100 shares out there and you own one of them. You own 1% of the company. Now, if that company buys back 10 of those shares, there are only 90 shares left. Your one share is now a bigger piece of that same pie. Your ownership just got more concentrated, and you didn't have to lift a finger or pay a dime in taxes. But, and this is a really important but, we have to look at the whole picture. As this commentary points out, buybacks have a dark side. A lot of times they're used not just to reward shareholders, but to cancel out all the new shares that are printed and handed out to executives as bonuses. So while you should definitely favor companies that do buybacks, you also have to be careful they aren't just using them to make management rich. It's a powerful tool, but you've got to watch how it's being used. All right, let's bring all this home. We've got a historic shift in how wealth is made. We've got a tax system based on labor that's breaking down. And we've got an inevitable government pivot to taxing capital. This isn't just some interesting trend to watch. This is your new financial reality. And here is the brutal, honest truth of it all. For our parents' generation, the main path to getting ahead was getting a raise, a rising salary. But we are moving so fast into a world where that is just not going to be enough. In the coming years, as the value of labor gets more and more uncertain, the growth of your capital, your investments, will become your main line of defense. Your financial well-being is going to depend a lot less on your next raise and a lot more on the performance of the assets you own. And so that leaves us with one final and honestly the most important question. Take a hard look at your own investments. Are they set up to win in a world that will absolutely tax capital more than labor? Are you owning the asset-heavy infrastructure of the future? Or is your portfolio still playing by the rules of an economy that is fading away right before our eyes? That's the question to really think about long after this is over.